Yes, believe it or not, part of the process at the year end is a look at every individual security and then work out whether the cash flows from that security mean that you need to take an impairment. There are precise rules that you have to follow, and in fairness, those impairments, or the difference between the market value and the book value, was a considerable amount, £1.6 billion.
Well, that's only 5%, or call it 6% if you want to be specific, on the total value of the portfolio.
No, that's absolutely right. So the full portfolio, having gone through that work, we still believe that the amount that we've got in our books fully reflects the realizable value of those bonds.
So as long as the companies pay the interest that is due on the bonds, all is well. But what if a company, a big one, were to go belly up?
Well, if it goes belly up, there is a default, then there is a shortfall in our capital, and therefore if we're going to carry on with the capital at the same level, then we have to put more money in. Mm-hmm. If you look at last year, the charge for actual defaults was only £85 million, and in fact this year to date there have been no defaults.
Is this because you've managed to be fortunate in investing in only companies that are going to survive, or are you getting a bit close to the wind?
No, I mean, when you have a big portfolio, the portfolio of total assets, $17 billion, $12 billion in bonds, you manage a portfolio with different rated securities, you manage a basket across sectors, and therefore the aim is that if you do have a default, it will be an isolated instance and not the whole through the whole portfolio.
Julian, the concern was that Old Mutual was writing a lot of guaranteed products in the United States, and to make sure that you could fulfill those guarantees, you had to go for increasingly more risky bonds. And you've got quite a big percentage of your portfolio in triple B or even worse than that. That, I think, is what is concerning the market. How can you put investors' minds at ease?
Look, you're right. The basic model of the business is you take an individual's premium, they get a tax deduction for it, and we invest that money in bonds, in corporate bonds. We get a spread on those corporate bonds, and from that we deduct commission, expenses, and what we believe would be a reasonable level of defaults. There will always be securities when you have a big portfolio that will run into problems, and therefore you have to impair. So that is a prudent way that everybody goes through. Now, what has happened to everybody who has a US life business like ourselves? And remember, our type of business is a life company which specializes in looking after people's retirement money. When they want to come out of the equity market, they come into our sorts of products. So there is a huge pot of money across the whole of the sector in the US. And the phenomenon of what is happening at the moment is corporate bonds right the way through America are having impairments, and there is question marks because of corporate America. The work that we've done, we are no worse off. Our portfolio is no worse off than our competitors in the whole of the US.
If you have a big bang somewhere, you might have to come to shareholders for more capital. That's the reality of the situation you're in.
The work that we've done and what we went through with at the year end in our presentation is we did some very significant stress testing. We went back to the worst time for a single year phenomenon, back to the 1930s, back to the Great Depression, and we took those scenarios and worsened them on stress testing to see in that type of environment how much capital would we require. And at the end of the day, when we went through, and as we said to shareholders, and I think reassured shareholders, we have significantly more capital than we'd need in a 1930 scenario.
At that time, a lot of the AAA companies became junk bonds. Was that the kind of scenario that you painted as well?
Yeah, it is quite interesting. Somebody else was saying this to me today. One of the problems, people often look at triple B securities and say, look, they're the ones that aren't quite safe. When you actually go back to big defaults, it's the Enrons of this world, it's been the big banks, and they happen to be the highest rated quality. Mm-hmm. And I don't believe anybody can work through that that position and safeguard against a rogue corporate going down. And that's why you have diversity across the portfolio, and that's why we've got the diversity across the different type of rating and the different sectors.
What is your biggest single exposure? What percentage of the total portfolio would it be in one particular security?
It would be really quite small, and it would be, I have to say,
Under
Alec,
1%.
Alec, I haven't got it in my fingertips. Oh, yes.
Would
yes.
be under 1%.
Yes.
All right. Just having a look at the restructuring that you've done, and you really have wielded the axe and made some big changes within Old Mutual. Obviously, these were really necessary.
Yes, I believe that Old Mutual had got too large, was trading in too many different areas. I think we needed to look at the management style and the management structure. And, I really go back to what I learned while I was running Scandia. And I believe that if you can put like-minded businesses and like-minded people together, you can get a huge amount of additional value and you can reduce the risk. So, one of the big changes I've made is to put Paul Hanratty, who currently runs OMSA, in charge of all of our life businesses. Now, I've done that.
He hasn't much experience in the US. I mean, you're asking a lot of him.
I'm asking a lot of him, but I think he's an extremely capable person. He has done a terrific job in OMSA over the last 3 years. But I think there is a significant amount of additional value we can get across the life sector of Scandia, the US life business, working better with OMSA. And that's what I've asked Paul to do, to get at that additional value out of our long-term savings business.
Julian, if one has a look at Old Mutual over the past 10 years, it's just about every mistake that could have been made has been made. And I guess shareholders are saying, how is the new chief executive going to make sure that those mistakes are not repeated? From share buybacks at the top of the market to buying companies that have not been smart purchases, not only at price, but what's been in the business, etc. How are you going to make a difference?
The difference I'm going to make is make sure that we've got high caliber people running the group businesses, and that they operate within what we call the risk appetite for each business. And therefore everybody knows what capability and what is expected of them. I want to run the group much closer, to have much more oversight of individual businesses and take away more of the flexibility that people had in the past. I think this is a really solid group with really good businesses, and I believe I can get the whole thing back on track and get the real value for shareholders that they haven't had in recent years.
But the decisions that were made were presumably not made by one or two people. They would have been board decisions. They would have been the culture of the organization that encourages to make them. How's that going to change?
Well, a business comes down to people. At the end of the day, we didn't have the correct management team, I believe, in the US, protecting our interest and running those businesses. That management team is gone, and I have selected new management to come in. I've put in new governance processes, and I believe that we really can. We can't correct the mistakes, but learn from the mistakes, and I'm very confident that we can move this business forward the right way.
Many shareholders, many investors are demonizing Mike Levette, the former chairman of the company. What's your opinion of the role he played?
I think that's extremely unfair. Mike, if I go back, I joined the group at Mike Levette's time. It is absolutely clear that the demutualisation and the investment in overseas asset has been proved to be at the wrong time. Through this period of 10 years, the South African businesses and South Africa in general has done very, very well. We're in a phenomenon now in the rest of the world, and we're seeing early signs of a slowdown coming in South Africa, but in the rest of the world that nobody can have foreseen happening. We're in a 1 in 100 event in the world. And so therefore anybody who has invested in this period of time in an international business would be suffering. That is not to say that over the next 10 years or the next 20 years that real value can't come from the international portfolio. And I believe if I structure it correctly, it certainly will do.
Julian Roberts is the Chief Executive of Old Mutual.